Hi, my name's John Stevenson, the Guaranteed Retirement Guy. Today, let's talk about how to guarantee income for the rest of your life, and if you're married, your spouse, without the use of stocks. All right, so just disclaimer here, I love stocks. Okay, I love them. And I love risk. Okay, but I also love guarantees. Okay, and that's why I talk a lot about annuity contracts, because I love the guarantees that you can get from an insurance carrier. You know, these carriers, they specialize in life insurance that protect us from, basically if we live not long enough and our family need, something to survive on when we die, that takes care of them. Okay, an annuity contract is just the opposite. It takes care of us and our family as long as we live. So it's longevity risk protection. Okay, so if you're wanting to do something other than using stocks, because they fluctuate, and especially during the lost decade from 2000 to 2013, you had the dot-com crash, you had the housing crash, and when people were taking out their 4% withdrawal rate, the safe withdrawal rate that all their advisors said it was okay, the problem is they couldn't keep doing that without running out of money. And in fact, what would happen is if you need a $40,000 from $1 million and the market went down during the dot-com, you had to take like 10, 12% out. Okay. But then when it starts recovering, you have less money now that's recovering. And so then when that housing crash happened, they had to again increase their rate of withdrawal. And so for many people, this meant going back to work. Maybe they were already retired, or for some, they were planning to retire and then they had to put it off for another decade. Okay. So protect yourself from that. And you can do it with an annuity contract, because if you have an annuity contract in place and you have a strong company, then you're going to have steady income for the rest of your life without using stocks. Okay. So, and I want to show you how this works. Okay. I'm sharing my screen, and right now I usually don't use this large of amount, but there are people that come to me with $1 million or more and they want to put it into a contract. And so we're going to look at this, and I'm just going to assume this person is married. Okay, they're 65, their spouse is 65. They got $1 million and they're going to start income at age 70. Okay, that might not even be close to what you're looking for. And if it's not, that's fine. You can go to my website, johnstevenson.com, and play with my annuity calculators. Okay, you'll see all of the options available. I don't hold anything back. If you're looking for highest guaranteed income, then choose the income rider option. Okay, that will give you the highest lifetime income, because that's what I'm showing you on this video right now. Okay, so if we go in here and say, all right, so starting income at age 70, of course it's going to be a lot, but how much? We'll look here right now. All right, so Corebridge is paying $106,875 guaranteed for the rest of your life, followed by Nassau, American Equity, Meritage, Midland, and so on. Okay, so not bad. If you're looking for A-rated carrier, $106,875 is not too bad. If you want to spread it out, maybe put it in Corebridge, maybe put it in American Equity, and maybe put some in Midland. Midland's A+. So you can spread it out like that if you want to. You don't have to, but if you want to, you can spread it out among several companies. And then the income will be virtually almost the same, and you'll just have it coming from 3 different contracts. Okay. So what if you're like, well, I want to wait till I am 73. Okay. Maybe it's an IRA. Okay. It's an IRA. You don't have to take any RMDs till you're 73. And a lot of times with annuity contracts, they will actually satisfy the RMD requirement. If they don't, you got to have other IRA accounts out there that will satisfy it. So anyways, if you look at this, you say, all right, well, Nassau is the largest one, but I want A+ rated. So Midland is $133,000. Okay. I would pick that over Nassau because of the ratings. Okay. And their Comdex score, they've been around for a long time. They are just a solid carrier. I would absolutely pick them. Then you got Meritage. They're good. They've been around 100 years. They're A-rated. And then you've got North American A+. So you could spread it out among these top 3 A-rated carriers and you'd be fine. Okay, and you can see the income payouts are very, very close. So that's nice. That's nice when you want to spread out. And you might want to take income, at 70 and 73 and 72, right? Maybe you want to spread them out a little bit. You can do that. So, and even if you want to spread it out longer than 73, you can do that. And probably what will happen is your RMDs will still be covered from your other contracts that are paying out, and you can look at that with your advisor, with your accountant. We can kind of collaborate and see, all right, what would be the best situation for you. Okay. So I'm happy to talk with them. But I just wanted to show this to you because when you're looking at creating income without the use of stock market, annuity contracts will give that to you. Now, it doesn't mean that these annuities don't grow. They do grow. And we can look at the account balance. They're not going to grow very much though. So I'll just give that as a disclaimer. These are not growth products. They're income products, okay? And so if you're looking for an income product, there are annuities that will do that. And we'll look at that next, okay? So we'll look at this and say, all right, well, look at the allocations here first. And whenever you're looking at indexed annuities, I'll just put in the top 3. Just make this easy. Let's look at the income. The income never changes. Doesn't matter what the index does. So they show you, hey, if the index does nothing, you see the rider charge right here? Yeah, they're charging $12,500 per year. Okay, that's what they're charging to give you guaranteed income. Okay, but you notice over time that would reduce the amount in there if there is no index earnings. Okay, the income's the same though. See, that doesn't change. If we go to hypothetical growth, then it'll probably grow to 1.4 million if it has decent growth during this period. Okay, still the income is exactly the same. The only difference is now your account value is going to go down a lot slower. But it's still gone. By the time you're like 87, it's still gone. Okay, so you're doing this for lifetime income. That's what matters. You can see if you take it out to your 95, you've taken out $3 million. Okay, so I like that. It's nice to be able to have that guaranteed paycheck regardless of what the stock market's doing. And if the index does well, if the stock market's doing well, then you most likely will have index credits. You're going to have growth because they're going to exercise those call options. If the market's down, they're not going to exercise those call options and you won't make any money, but you won't lose any either. Okay, so having said that, let's look at just protecting your money and maybe taking some income and maybe getting some more growth than what you can get here. Just remember, the income is not going to be guaranteed, and I'll show you why. Okay, because these are income riders that we're looking at. Income riders, if you're looking for highest income, you could absolutely get highest income with an income rider. Okay, but your account balance is not going to stick around forever. Okay, remember that. You're taking out a large amount of income, and that's going to affect your balance. Okay, so most people, that doesn't matter to them. They want this for income, and they'll leave their other assets to their beneficiaries. That's usually the best option. Or you could buy 2 different annuities. You can get one for income, one for growth. And we can look at that too. I sell both. All right, so let's look at what if we wanted some of the market growth, not all of it. You're never going to get all of it, but we also want the protection. And we want some income. Okay, we want some income as well. So let's go in here and we'll look at some different options. So performance analyzer, and I just want the S&P 500. Okay, I want to make this I really want this to be as conservative as possible, and I want to be able to have the highest growth, but I want it to be with an index that is proven. Okay, because there's a lot of indexes out there that are fancy, that they will show lots of returns, but they're all back tested. Okay, all right, I'm going to go in here and say, well, I want this to be annual. I want it to be point-to-point annual because I want more compounding periods, more chances for my money to grow. Some of them will offer it 5 years, and it's measuring the index for 5 years. The problem with that is you don't have any growth, any index credits for that 5 years. So that can really be a downer for some people. All right, so let's just look at the top one. Security benefit, S&P 500. They are giving you a S&P 500 point-to-point with a spread. So they're giving you 90%. That's not bad. The spread, though, is 3%. So, that's quite a bit of a spread. But the market's doing well, and they're charging you a fee for it, okay? If you go down a little bit more, they're offering you a little bit lower, let's say participation rate of 80%, same spread, but there's no fee. So you see the fee is giving you a little bit more. Okay, so that's kind of how that looks. Then you got Life of the Southwest, owned by National Life Group. They're really, really good. In fact, I do recommend them highly because they keep their rates so high. They're giving you a cap of 14% with an account fee of 1%. Now that, to me, is worth the 1% if my cap is higher. So look down a little bit more. What if I don't want any fees? Okay, you can do that. No fees. Nothing. Okay, let's see here. If I can get a little bit higher return and get some income, that's really what I'd like to do. Okay. All right, so some of these returns are kind of outrageous. 20%. I mean, I've seen returns as high as 14, but 20% might be a little far-fetched, but let's take a look. All right. Just fair warning, though, a lot of these numbers are kind of high to illustrate, in my opinion. Okay, so I'm going to go withdrawals. And let's say I want to take out withdrawals of, let's see here, 133,000 is what we're going to do, right? So let's just compare it apples to apples. So we know by the age 73, I can get 133,000 guaranteed. So let's just base it off of that. So we'll say 133,000, start at age 73, and at age 95. And the other one, though, doesn't end at age 95. It'll go until you're 110 or 120 if you live that long, okay? So that's the nice thing about that. It is guaranteed, This is not. Okay, we're hoping that it'll give us huge returns, and we're going to take income anyways, and we'll see what it looks like. All right. Worst case scenario, if there's no growth, you're going to run out of money by the time you're 81. Okay, but that's saying the stock market shuts down. All right, so let's go to growth. Wow, look at that. Well, with growth, you can take 133,000 out, and your account value grows. All right. See, as long as it grows like this, you'll be fine. But that's all hypothetical. Okay. If you're looking for something guaranteed, I would not choose that. So just my opinion. So if we go in here, I'll just look at the allocations, and I'm saying, all right, well, what if it doesn't earn as much? What if it just, I'm going to dumb down these numbers a little bit. I'm going to dumb it down. What if we just, don't have very good years? What if they change the participation rate or the cap rate down because the cost of the options are really, really high? That could happen. Okay, well, let's look at that. This is why it's important to know this is hypothetical. Okay, if we look at that, then you can see you're taking 133,000 out. You get an okay returns, but eventually, by the time you're 93, you've taken out the last portion, like 67,000. So it looks like your income could still last until your 90s. Okay, that's not bad, but it's hypothetical. It is all based off of the growth here. Okay, so you have to remember that. So if you're looking for absolutes, pick an income rider. Okay, go to my website, johnstevenson.com. You'll be able to actually see all of the annuity calculators that I have. Okay, you got SPIA, DIA options, you got QLAC, you got MIGAs. Those have their purpose. If you're looking for highest lifetime income annually, the income rider is always the highest one. Okay. So if you want to plug in your details and just kind of play with it, that will show you exactly what it is. And then you can book a call with me if you like, and we can talk about what you're looking for in an annuity. I can sell one to you. We can fill out the application if you like, or I won't sell one to you. Okay. It's all depends on you. I'm here to help. I'm not going to try to push you into anything, but I will show you everything that's available. I'll answer your questions as well. So anyways, hope this has been helpful. Okay, if it has, like, subscribe, share, comment below, and I'd be happy to answer your questions. So I appreciate you watching, and we'll see you next time.